Hello everyone. The financial year FY23 has gotten off to a volatile start. The month of April saw the large cap Nifty index fall by about 2%, while the NSE mid cap index was flat and the small cap index was down 1.7%. However, despite all this volatility, the domestic equity markets outperformed the MSCI Emerging Market Index as well as the MSCI World Index in the last month. Foreign institutional investors have remained net sellers of Indian equities in the month of April, while domestic mutual funds recorded inflows and they remain net buyers, therefore supporting the market. The market has been clearly focused on the direction of monetary policy moves by the US Federal Reserve as well as other central banks the world over. Inflation trajectory, crude oil price movement, as well as the continuation of geopolitical tensions between Ukraine and Russia were some of the key factors that impacted the markets. Early in May 2022, the Federal Reserve has delivered a 50 basis point rate hike, bringing the Fed fund rate close to 1%. Now, this follows a 25 basis point hike in the previous meeting. The Fed, remember, has also outlined its plan for monthly balance sheet runoff starting June. If you look at domestic markets, the focus here has also shifted towards inflation as well as monetary policy normalization. If you look at India's CPI, the CPI rose to almost 6.95% in the month of March. A lot of the rise in the CPI inflation was led by food. And we do expect that in the near term, the pass-through of elevated commodity prices is likely to continue, both in terms of agriculture as well as non-agricultural products. The persistence of supply chain disruptions could pose upside risks to inflation. Now, with this backdrop, the Monetary Policy Committee of the RBI held an off-cycle meeting, and as a result of this, based on their macroeconomic assessment, the MPC unanimously decided to hike policy repo rate by 40 basis points to 4.4%. They've also increased the cash reserve ratio or CRR by 50 basis points, and this would result in the withdrawal of almost 87,000 crore of durable liquidity from the system. Now, clearly, the hike in the repo rate is aimed at anchoring inflation expectations. Now, while inflation is a concern, on the growth front, the high frequency economic indicators in the country continue to remain fairly buoyant with the opening up of the economy. The latest data on GST collection shows that GST touched an all-time high of 1.68 trillion rupees in April on the back of improvement in economic activity. Monsoons are also expected to be normal this year, and this, along with an increase in food prices, could bode well for the revival of the rural economy. Now, as you know that we are in the midst of the Q4 FY22 corporate earnings season. As we speak, about 24 Nifty companies have declared results, with YOY sales growth at about 17.6%, EBITDA growth being lower at 11.4%, but PAT growth of about 22%. Hence, so far, earnings at the headline level have been largely in line with expectations, and we have not seen any downgrades to FY23 earnings as yet. Now, while we have not seen downgrades as yet, we must remember that higher commodity prices as well as supply chain bottlenecks are risks that we need to monitor. In the near term, it is possible that earnings do face some degree of margin headwinds. With commodity prices being elevated, some margin pressure is likely, especially in Q1 of FY23, even as companies have started taking price hikes to offset the higher input cost pressure. We, however, believe that the second half of FY23 could see some of these uncertainties, especially around crude and commodities, start to abate, and that could help bring back focus towards the medium-term earnings growth trajectory of Indian companies. In a nutshell, what we are really saying is that inflation and monetary policy normalization is taking center stage in India as well as the world. Now, if you look at Indian markets have corrected and valuations have come off to some extent. However, India's valuation premium relative to other emerging markets is still higher than historical averages. Hence, while we are positive on equities in the medium term, in the very near term, we would have to navigate some degree of volatility. Monetary tightening, along with elevated inflation, would likely result in interest rates moving on an upward trajectory. We believe that this year would be a year of bottom up stock picking. Now, while markets may not be very cheap on valuations, stocks have corrected. And therefore, we are looking at companies which are market leaders in their sectors and subsectors. Companies that have strong balance sheets and cash flows with low leverage and valuations being reasonable. We also, at this point in time, have a slight preference of large caps over mid and small caps, given the current valuations in each of these segments. We would, however, continue to evaluate good quality mid and small cap names trading at reasonable valuations from a long term perspective of 3 to 5 years. Now, coming to some of the sectors and themes that we are positive on. Firstly, industrials, manufacturing, and infrastructure. Now, manufacturing growth continues to remain strong, with public capex remaining buoyant and signs of improvement in an overall capacity utilization level. Manufacturing is also benefiting from the supply chain shift away from China and the government's policy on Atmanirbhar Bharat. The second segment that we are looking at is the financial sector space. Now, in this, we are clearly focused on the large private sector banks. Now, these are banks which are gaining market share, both in loans and deposits. They have a strong retail as well as low cost liability franchise, which is very important in a rising interest rate environment. Asset quality has improved. They are well capitalized and well placed on the technology front, and valuations are reasonable. The third segment that we are looking at is the real estate and home building segment, which we believe is a structural theme. And finally, we are approaching the pharma sector on a bottom up basis. Here, we are focusing on stocks where growth is likely to remain strong, especially India business led growth, helped by sharp recovery, especially in terms of acute therapy, as well as non COVID procedures picking up. Now, with this background on terms of how we are looking at markets and various sectors, we would like to advise all our investors to continue with their disciplined approach towards investing. Keep in mind your risk profile, your long term investment goals, as well as your asset allocation strategy. These are volatile times, but I'm sure we will be able to navigate the same with a very disciplined mindset. Happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.